Title II. Title II covers loan insurance for many properties and situations. Each program has its own rules. Some of the options available from FHA are: Section 203, the purchase of 1 to 4 family homes. Section 203, victims of disasters may receive 100% financing to reconstruct or replace a damaged home if they file within 1 year of the disaster. Section 203, purchase of a unit in a cooperative housing project. Section 221(d)(3), for construction of multifamily rental or cooperative projects. Section 223, purchase or rehabilitation of a home in an older, declining urban area. Section 234, purchase of a single condo unit. Section 251, loan insurance for adjustable rate mortgages. Section 255, loan insurance for reverse mortgages for borrowers age 62 or older. FHA Streamline Refinance Program. The FHA Streamline Refinance Program allows borrowers who already have an FHA loan to refinance. So what, you say? Here's what: the program allows a refinance without verifying the borrower's income or assets, and in some cases, without even requiring an appraisal. The Streamline program is the simplest and easiest way to refinance an FHA loan. One of the biggest advantages to this program is that it allows for an unlimited loan-to-value ratio. In other words, the borrower doesn't need to have any equity in the property. Therefore, even homeowners who are severely underwater may still be able to take advantage of lower mortgage rates by refinancing with an FHA Streamline. To qualify for a Streamline refinance, the mortgage must already be FHA insured. The refinance must result in a reduction of mortgage payments. The homeowners must be current on their mortgage payments, not delinquent. No money may be taken out. FHA Reverse Mortgage Program. Reverse mortgages are nothing new, they've been around for decades. Thanks to FHA's mortgage insurance, HUD's Home Equity Conversion Mortgage, HCM, makes borrowing equity from one's home less expensive and safer for both the lender and the homeowner. HECMs are now the most common form of reverse mortgage. Example: Gerald is a 72-year-old widower, and although he's paid off his home, his medical bills are starting to overcome his fixed income budget. He decides to make use of the equity in his home, so he obtains a reverse mortgage through a lender that participates in HUD's Home Equity Conversion Mortgage Program. The HECM program allows Gerald to decide if he wants to receive the money from the lender in a lump sum, on a monthly basis, or as a line of credit. Gerald opts for the monthly payment, and chooses to receive this for as long as he continues to live in his home. He could also have chosen monthly payments for a fixed term, and if Gerald's circumstances change, he is allowed to restructure his payment options. Gerald now feels much less financial stress. Based on his age, the fact that his home was fully paid off, and the value of the home, he was able to borrow a substantial amount of money. Gerald can now cover all his bills with the monthly income from his reverse mortgage. He's careful to continue paying his homeowner's insurance and property taxes, since he was counseled that not doing so could result in foreclosure. He also knows that even if he outlives the amount that he borrowed, his monthly payments will continue as long as he continues living in the home. As it turns out, Gerald lived to the ripe old age of 85 and was able to remain in his home until the very end. At that point, it was time to repay the loan, which his heirs did in the most typical way by selling the house. The sale price covered the repayment of the reverse mortgage, with enough left over to give each of his children a small inheritance. Gerald qualified for the HECM program by virtue of being age 62 or older and having paid off his mortgage, or having a very small amount left to pay. The amount that a homeowner receives from a reverse mortgage is based on property value, the borrower's age, and current interest rates, with a total loan limit that is set annually by the FHA. Program benefits. The benefits to those who want to obtain the HECM include: no monthly payments, no asset or income qualification or limits, the option of receiving a percentage of the value of the home equity in a lump sum, on a monthly basis, or as a revolving line of credit, no repayment of principal, interest, or fees until the surviving homeowner leaves, continued payments as long as a surviving spouse remains in the home, no debt to the estate if the eventual sale does not repay the balance owed to the lender. The FHA will cover the remaining amount owed to the lender. In addition, the Housing and Economic Recovery Act of 2008, HERA, added new provisions to protect seniors who use the HECM program. These include the ability to obtain an HECM loan in a single transaction for seniors for whom the home is a primary residence. Counseling to help homeowners understand that the equity payments could result in zero equity. A prohibition to lenders from requiring the borrower to buy insurance to protect the lender from a negative balance at the end of the loan program. Homeowners are still required to carry hazard and other homeowner insurance, and must make these payments or risk defaulting on the loan. A limit of origination fees to 2% of the maximum claim amount up to $200,000, and 1% of the maximum claim amount over $200,000. Lower valued homes, less than $125,000, are limited to a $2,500 fee. Note, since HERA, cooperatives are now included in the program, as well. As with other FHA-insured loans, the FHA collects an insurance premium from all HECM loans. The premium is 1.25% of the loan value. An initial mortgage insurance premium fee, if applicable, will be between 0.5% and 2.5%.